All 11 S&P sectors are trading above their 10-year averages. But on a relative basis, there's opportunities in several sectors, with the financials and healthcare appearing extremely undervalued. Jonathan joins us now for more. John, just going back over your research over the last month or so, you asked, I think, the most important question, and others were asking it too, how willing we would be to de-emphasise the near-term risks and price in a much brighter forward outlook. And this morning's just a classic example of that, John. Do you think we can keep looking through the weakness in the data in the near term?
You know, I think that's, let's put it this way. If you were a hedge fund and you had a 6-week outlook, I would be pretty cautious here. I think that not only are we seeing weakness in the recent jobs data, we've seen this in retail sales. I think it's going to prove to be a somewhat soft Christmas season. And there's still uncertainty on whether we get the stimulus package passed. But if we look beyond this towards next year, this is all these risks fade away. The economy is going to be getting better. And I think we forget the biggest stimulus plan ever known to man is going to be the reopening of the world economy in the middle of this year when all of us get a vaccine.
So, John, let's talk about the price of the story. You've got the headline valuation of the index, and then you've got the relative valuations within it. You were looking at that in recent research, John. What did you find?
Well, you know, the most important thing is two areas that are incredibly unloved by the market, which is financials and healthcare, just look obscenely cheap. And they both have a different story. I think on healthcare, there was a lot of concern that if we had a Biden presidency, that he was going to beat up on healthcare. And I don't think that that's going to be the case. And with respect to financials, the sentiment is horrible, but the fundamentals are looking increasingly positive. So I think that those are going to be your two best sectors in the year ahead.
This is a relative valuation story, though, John. In the work that you've done, and I know you backtest a lot of this and look over history, what's more important here, the headline valuation of the market or the relative valuations within it?
Oh, well, first of all, I mean, if you said to me what's really important is the fundamental stories here. If healthcare is cheap, you know, because something's broken, then you don't want to touch it. But if the risks are coming down and it's cheap, then that gives you a huge amount of spring. But we really do care about relative valuation. I don't care that the market right now is at a 22 multiple. What I do care about is where can I get something that's attractive at a bargain? And there's quite a number of those types of areas.
John, I want to talk about growth equities as well, because through much of the summer, it was an argument you made coming into the fall. Stick with the growth names. This is where the earnings growth is, and stick with these names into 21. I remember a note in the last month or so talking about the 12-month outlook in 12 months, and growth is where you'd want to be, that this cyclical rotation would largely be behind us. John, is that still the case, or has something changed with you and the team?
You know, I think it is. I think that there is a potential for us to get a larger cyclical surge than perhaps I had originally thought. And here's what you might get. If we got a $1 trillion, a $900 billion stimulus from Washington, and then we reopen the economy, and the Fed is not backing away from this incredibly dovish policy or the sentiment around that, there's the potential for things to open up, you know, really strong. If they do, I think the risk in the back half of the year is that, and you were asking one of your guests earlier about the yield curve steepening, the Fed may have to at some point stop, you know, basically pull back from this dovish tone, and the market may not like it as much. But for the near term, the backdrop is extremely positive.
John, it's been fascinating through the year trying to work things out with a range of guests, including yourself. And I just wanted, John, just to wrap up this conversation, what's been the biggest lesson for you and your colleagues over at Credit Suisse for 2020?
Gosh, you know, it probably you know, if we look at all the things we got wrong, and mind you, you get a lot right, but you always focus on what could I have gotten smarter at. The companies in the S&P, their ability to deliver really strong profits in an incredibly ugly environment was just amazing. 65% of the companies in the S&P 500 have stronger earnings in 2020 than they did in 2019. And the growth index, you know, 85% of the companies will have stronger earnings this year. And I really, as much as I'm a big fan of these large growth companies, how strong they are, even I underestimated how good they would do in this type of environment.
Truly historic to see that second quarter tech earnings roll out. John, great to catch up, sir. Appreciate your time as always. My best to the family. Jonathan Golub there